The United States Federal Reserve lowers interest rates by 0.25% amid cooling inflation and weakening labor market. China approves $1.4 trillion package to tackle hidden debt issues. And Citi predicts that a second term for President-elect Donald Trump could push Brent crude prices down to an average of $68 per barrel through 2025. Welcome to the Economic Bulletin, where we present a comprehensive coverage and expert insight on key updates regarding pivotal economic trends and financial shifts. The United States Federal Reserve lowered interest rates by 0.25% amid cooling inflation and a weakening labor market, marking the second rate cut in its easing cycle. Despite the election results, Fed Chair Jerome Powell stated that these developments would not have any near-term effect on U.S. monetary policy. In support of its goals, the committee decided to lower the target range for the federal funds rate by 0.25% point to 4.5% to 4.75%, the statement reported. The Fed's latest decision came after a weak employment report, which showed that the United States employers added only 12,000 jobs in October. Amid the cooling labor market, this slowdown was worsened by a strike and the impact of recent hurricanes.
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Canadian Prime Minister Justin Trudeau has announced the creation of a special cabinet committee focused on Canada-US relations. In response to concerns about a potential second term for Donald Trump as the United States President, the Prime Minister's office said that Trudeau spoke with US President-elect Donald Trump about trade, including the United States, Mexico, Canada agreement that they negotiated during Trump's first term. According to the statement from Trudeau's office, the special committee will address critical issues affecting the relationship between Canada and the United States in light of Trump's re-election. Deputy Prime Minister and Finance Minister will chair the committee, which also includes key officials such as the Ministers of Foreign Affairs, Public Safety and Industry.
Win Indianapolis and Daytona, and they fight and they spend, even Canada, they spend a lot of money.
I look forward to working with President Trump once again to strengthen North American economic opportunities for the middle class, to grow our economies in ways that make us competitive around the world, to protect North America from the many, many challenges that exist around the world. The world is actually even more difficult and more complicated than it was 4 years ago. And I know that there's lots of work for us to do, and I'm looking forward to do it. On our side, we've been preparing for this. We're looking forward to doing this work.
Still in Canada, where official data has shown that Canada's economy added fewer than expected 14,500 jobs in October. Data also showed that wages of permanent employees rose by 4.9%. Statistics Canada said that the unemployment rate stayed unchanged from September, but hovered around a 34-month high of 6.5%. Moving to Europe, EU leaders are meeting for a second day in Budapest to discuss the European economy and competitiveness, with a focus on adapting to the new geopolitical landscape following Donald Trump's re-election as the United States president. The leaders are expected to tackle key issues around strengthening Europe's economic autonomy, including innovation, industrial renewal, energy sovereignty, and defense readiness. The summit also includes a broader debate on foreign affairs. Leaders will address EU-US relations, especially around security and global challenges.
I would like to invite you to take your seat, please, and the press will enter into the room to take.
Taiwan's exports grew 8.4% year-on-year in October to $41.3 billion, falling short of the 9% growth forecast, but marking the 12th consecutive monthly increase. The rise was driven by demand in sectors like artificial intelligence, though it was tempered by weaker economic conditions in China, Taiwan's top trading partner. Exports to the United States surged 2.5% to $8.65 billion, though slightly lower than 27.3% growth in September. The Finance Ministry remains optimistic for a strong fourth quarter, citing lower interest rates in major economies and a strong AI demand, alongside the upcoming year-end shopping season in the United States and Europe. Still in Asia, China's top legislature has approved a 6 trillion yuan increase in the local government bond limit, raising the total to 35.52 trillion yuan. Officials announced after a week-long parliament meeting that Beijing will let local governments allocate 10 trillion yuan towards reducing off-balance sheet or hidden debts. The move is aimed at easing debt repayment strains and boosting the economy, with Finance Minister Lan Fuan indicating further stimulus measures are coming. Fuan estimated that the hidden debt of local governments was 14.3 trillion yuan, approximately $2 trillion at the end of 2023. The vice chairman of the National People's Congress Financial and Economic Committee said at the news conference that the plan will be implemented over the next 3 years. And in a bold move to combat its rising debt crisis, China has just approved an $839 billion plan aimed at easing the financial strain on local governments. But what does this mean for the broader economic landscape of the world's second largest economy?
China is facing an uphill battle. Beijing announced a sweeping plan to help local governments manage and reduce their hidden debt, estimated at a staggering 14.3 trillion yuan, or nearly $2 trillion by the end of 2023. This type of debt, often kept off the public books, has posed severe risk to economic stability. Officials laid out a strategy to inject 6 trillion yuan over 3 years, starting in 2024, to support local administrations in refinancing their financial burdens. The government hopes that by 2028, this undisclosed debt will dwindle to 2.3 trillion yuan, drastically reducing the shadow looming over provincial economies. This plan comes as China grapples with larger economic challenges, a property market slump, high youth unemployment, and slowing consumer spending. The country's traditional engines of growth, like real estate and exports, have shown cracks as global demand and domestic confidence wane. Despite attempts to stimulate growth, these measures reflect a balancing act between fostering development and avoiding a debt spiral. With the ceiling for issuing special bonds now raised to nearly 35.52 trillion yuan, China's reliance on borrowing to boost local economies is clear. The key question is whether these efforts can revive China's economy or signal more drastic measures ahead.
Joining us today to discuss China's debt management plan and the wider economic challenges it faces is Mr. Meher Nicolas Ferzili, Director for the European Asian Center and former advisor to the World Bank. Welcome, sir, to Qnews.
My pleasure, my pleasure.
Sir, what does hidden debt mean in the context of Chinese local governments, and why is it a pressing issue?
I'm delighted to join you today from Paris. It's a very good question. It's interesting, the symbolism and the timing is interesting because, of course, what's happening in Beijing today is not happening in a vacuum. It's happening precisely 2.5 days after the surprise victory of Donald Trump in the US. Of course, the two issues are intimately connected. China's present and future economic issues or problems, and the fact that in less than 2 months now, Donald Trump will be the new US president. It's interesting because the Chinese government is very secretive and they don't like to speak in public, and they try not to communicate too much in public. But today, Lan Foan, the new finance minister of China, held a rare press conference. He doesn't do it very often, and he spoke more than usual. So it's interesting because we have a window, partial window, into the thinking of policymakers at the highest levels in Beijing. I think the news is rather bad. To make a long story short, I think it's maybe too little too late. So I think that the Chinese government was a little complacent regarding that festering wound, right? So the festering real estate finance crisis. It's been with them for 18 months or even 2 years. And every quarter or every semester, the crisis accentuates. They come back, they do some fiscal, economic stimulus, waving the magic wand of macroeconomic stimulus. And for a few weeks, the symptoms of the fever recede. And then 2 months later, there's a new round of issues. So to make a long story short,
sir, sorry to interrupt you, but you said surprised victory of Donald Trump. Why do you see the victory of Donald Trump from your own perspective surprising?
Surprising because maybe not in Cairo or Riyadh, but certainly in London, Paris, or Washington, most of the so-called experts, that's 80–90% of academics, journalists, experts, pollsters, had predicted an easy victory for Kamala Harris, especially in the last days. The last days, they all said, oh my God, Trump is collapsing. So it's a big victory because he not only won the states, the number of states he needed to qualify, but he also won the popular vote.
Sir, relate this to China, please, because I want it to be about China.
So there's an acceleration. So policy planners in Beijing and Washington call it Cold War II. So what is Cold War II? It's an acceleration of the new Cold War. And that war will be fought between China and America for the next 10–20 years, not using missiles or nuclear engines. It will be fought using two things: finance, financial power, investment, and high-tech research.
Basically trade, sir.
Yes, and trade in the middle. So the third item is trade, but more important than trade, because trade already after COVID or during COVID, we had, the global shipping lanes and transportations were disrupted. So already, and they've slapped tariffs. So America and Europe have already slapped high tariffs on China. So trade is done. The next step of that new Cold War revolves around investment, FDI.
Okay, sir, how do you assess the 6 trillion yuan plan to refinance local government debt? And do you think it's sufficient?
No, it's not that bad, but it's clearly not efficient. And the Chinese themselves, the finance ministers himself, during the press conference, hinted in a way, if you read between the lines, that it would not be enough, because he said, and I quote, that he stands ready in the future to do three things: recapitalize big state-owned banks, buy unfinished real estate projects, and strengthen consumers. So when you have a finance minister who says, I'll stand ready to do much more in the coming weeks, after putting $1.5 trillion on the table, it means there is a deeper problem. The Chinese know it. They can handle it, but it will be a painful road for China for the next 12 months.
Okay, so what challenges do you foresee in implementing this plan effectively over the next 3 years, sir?
Well, the biggest challenge is it's not enough. It's coming too late. So at provincial level, at local level, municipalities, counties, provinces, there's a big problem. So the Chinese government itself, not only the banks, they need to recapitalize their provincial governments, which are highly inefficient. It will cost a lot of money. It will be complicated because they're tied to the ruling Communist Party, so they cannot squeeze them financially too hard. Then there is the biggest problem, which is FDI, foreign direct investment. One of the big engines of the Chinese economic miracles was there were trillions of dollars coming every year into Shanghai, Hong Kong, Beijing from Canadian, Australian, American, English pension funds, insurance companies, industrial companies. These gigantic Western, North American pension funds and industrial companies, they're investing less and less into China. So foreign capital will be missing. Doesn't mean China.
Why are they investing less now, sir?
Because of that new Cold War, precisely because America is saying, okay, many of the technologies that you invest in China are dual use. They can be civilian or military. So you can use an engine to produce a car, but you can also use an electric engine to make a missile. And so they're putting pressure, the Americans, and now the Europeans too, they're putting pressure on investors not to invest in China. So these big investors are afraid, and progressively, they're transferring their investment away from China to Singapore, India, Malaysia, Indonesia. It's also part of the supply chain crisis. They're moving factories away from China to Indonesia, Malaysia, Singapore, India. All is happening at the same time. So China will have to bite the bullet. And I think one factor which could help China bite the bullet is the Arabian Gulf. Saudi Arabia, Abu Dhabi, they believe in China and they don't want to see China fail. So Arabian Gulf, sovereign wealth funds and pension funds, they will keep on investing in China, but it's not enough to make up for the loss of American and European money. But China has many things, China has many advantages like technology, research, hard work. So China can survive the crisis, but it will be a painful crisis in the short, medium term.
Yes, sir. Of course, we all wish China all the best because we know that China is one of the strongest economies all over the world. And thank you very much, Mr. Meher Nicolas Ferzeli, Director for the European Asian Center and former advisor to the World Bank, for your valuable insights, sir. Official data released has shown that China's foreign exchange reserves totaled almost $3.3 trillion at the end of October, marking a 1.67% decrease compared to the previous month. The State Administration of Foreign Exchange attributed the decline to a range of factors, including a rise in the US dollar index and a drop in global financial asset prices, influenced by shifts in monetary policy expectations and macroeconomic data from key economies. The administration also emphasized that the reduction in the reserve was first due to currency translation effects and fluctuations in asset values. Despite this, China continues to implement policies aimed at supporting economic growth, which is expected to help maintain the overall stability of its foreign exchange reserves. Central banks and the Gulf Cooperation Council have reduced interest rates following the U.S. Federal Reserve's second rate cut this year. The Saudi Central Bank lowered its repurchase and reserve repurchase rates by 25 basis points each to 5.25% and 4.75% respectively. The Central Bank of the United Arab Emirates cut the base rate for its overnight deposit facility by 25 basis points to 4.65%. The Central Bank of Bahrain reduced its overnight deposit rate by 25 basis points to 5.25% effective November the 10th. Similarly, the Qatar Central Bank cut its deposit, lending and repurchase rates by 30 basis points each, with the deposit rate now at 4.90%, the lending rate at 5.40%, and the repurchase rate at 5.15%. ADNOC Logistics and Services has signed contracts worth $4.4 billion to build 23 super tankers for ethane, ammonia, and liquefied natural gas. The CEO, Abdelkarim El Mousabi, announced that the company, through its IEW Shipping joint venture, awarded $1.9 billion in contracts to build 9 very large ethane carriers and 4 very large ammonia carriers in partnership with China's shipyard. Additionally, ADNOC Logistics and Services signed $2.5 billion worth of contracts with South Korea's Samsung Heavy Industries and Hanwha Ocean to construct up to 10 liquefied natural gas carriers, further bolstering its capacity to meet global low-carbon energy demand. The global investment bank, Citi, predicts that a second term for President-elect Donald Trump could push Brent crude prices down to an average of $60 per barrel through 2025. This is due to expected trade tariffs, a potential increase in oil supply, and a faster tapering of OPEC plus production cuts. Trump's policies may also reduce geopolitical tensions and increase oil availability in the market. Citi also notes that Trump could offer tax incentives for exploration and production and reserve some of the Biden administration's policies, such as higher royalties and lease rates on federal lands. However, his trade policies could negatively affect global economic growth, especially in Europe and China, dampening oil demand growth. Oil prices fell on receding fears over the impact of Hurricane Rafael on oil and gas infrastructure in the United States Gulf, while investors also weighed up fresh Chinese economic stimulus. Brent crude oil futures lost 1.23% to $74.70 a barrel. U.S. West Texas Intermediate crude was down 1.45% to $71.31 per barrel. Moving on to the gold prices, which slipped and were headed for their largest weekly decline in more than 5 months, as markets assessed the implications of Donald Trump's victory and its potential effects on the U.S. interest rate outlook. Spot gold fell 0.6% to $2,690.62 per ounce and was down 1.6% for the week. U.S. gold futures shed 0.3% to $2,697.90. And that's all for now. Here's a roundup of today's key headlines. The United States Federal Reserve lowers interest rates by 0.25% amid cooling inflation and weakening labor market. China approves $1.4 trillion package to tackle hidden debt issues.